Hey, Steve Saretsky here. As always, this is a Canadian real estate market update with a particular focus on Vancouver. If you get any sort of value or entertainment out of these videos, all I ask is that you hit thumbs up, subscribe. I appreciate your support. As always, if you have any questions or comments, put those below and we'll banter back and forth. I wanted to keep this video a little bit shorter, but I also want to touch on a few things. Many of these things I've been talking about for a while now. They seem to be all really coming to fruition at the same time. All really are now getting a spotlight. First things first, I wrote a post on this on my site a couple days ago before CBC and all the major news outlets picked up on it. But the Bank of Canada increased their mortgage stress test qualifying rate 20 basis points from 5.14% to 5.34%. So again, the new minimum qualifying benchmark is 5.34%. So basically, if you don't understand what that means, the implications of that, basically what it's going to do is that 20 basis point increase is going to reduce borrowing power by about another 1%. And that's on top of the 20% that the mortgage stress test already reduced. So as that benchmark rate moves up higher, you're reducing borrowing power. And again, if you don't know what that means, basically with that stress test, if you're borrowing a mortgage today at say 3.5%, you have to qualify at 2% higher than that. So it would be 5.5%. There's going to give you money based on how much you can qualify for at 5.5%. Now, if you're using say a variable rate, which is say 3%, so that plus 2 would be 5%. Well, they're going to qualify you on the benchmark rate, which is 5.34%. So it's whatever is higher. It's either the 5.34% or 2% on top of your borrowing rate. So basically, to summarize it all, at minimum, you're going to be qualified at 5.34% moving forward. So again, that's just reducing that borrowing capacity, reducing overall mortgage credit. Again, in the last video I talked about, you can see that mortgage credit growth has slowed to its slowest pace in nearly 20 years, and that is really a huge proponent of the stress test. And if you've read any of Professor Steve Keen's work or House of Debt, there's a direct correlation between mortgage credit growth and mortgage credit deceleration and home prices. So it's very important to watch moving forward. And I mean, this continued pressure on higher rates, so not only is the stress test moving up, right, because of those higher rates, which are mainly coming in from the United States, the Canadian 5-year bond yield continues to rip higher. Again, this 5-year bond, the Canada 5-year bond, is directly correlated to the 5-year fixed borrowing rates for your mortgage. So all you have to do is watch that bond yield and you can get a really good sense of where rates are going. It just clipped a 7-year high at 2.2%. Again, if that continues to move higher, banks are going to come in with another round increase on higher rates. And again, higher rates just reducing your borrowing power, chipping away. And this is why we're seeing basically condo prices in the city of Vancouver starting to top out, starting to see some 2-bedrooms take some price reductions. 1-bedrooms, yeah, they're getting multiple offers, but that price, you're not really seeing that price increase right now. It seems to sort of have hit a ceiling. And again, we'll have to see if that's a temporary thing or something more drastic. But I think with condo sales recently hitting a 5-year low in April, stress test qualifying rate going higher, that 5-year bond ticking higher, I think that's going to continue to put some downwards pressure, or it's going to keep a lid on what's happening in the condo market, which has been explosive really over the last 18 months. So that'll be interesting to watch. Again, I mean, follow the correlation between borrowing power. A lot of people are talking about, banning flipping and speculation, and that's really just, you don't have speculative activity unless you have liquidity in the market, and you need the ability to borrow credit is what creates liquidity in a market. So as liquidity comes out of the system with higher rates and tightening of lending conditions, that reduces liquidity and one's ability to actively flip properties. So it's a little bit backwards when governments talk about banning flipping, and I understand that speculation leads to higher prices, but at the end of the day, you can only have flipping and speculation in a liquid market. And as we've seen in the detached housing market, housing flips have recently fallen to a 10-year low because there's no liquidity in that market. You have sales at a 30-year low, and you have local people, as that foreign money is pulled out, and local people really can't afford those prices, particularly with the mortgage stress test. There's simply no liquidity in that detached housing market. So again, I think you solve that flipping problem by reducing liquidity and tightening mortgage credit, and that's certainly what's been happening over, more noticeably over the last 6 months. Speaking of liquidity and some of the things that I've been talking about, I've put a lot of emphasis on the pre-sale condo market. As I said, I think it's what they've been charging people is excessive. I think that we have right now a record number of new housing units under construction. We have new construction hitting an all-time high, and we have housing starts still at an all-time high. So you have a plethora of supply coming down the pipe as you enter into a market which is seeing falling sales and tighter credit conditions. And this is starting to reflect in the pre-sale market. Again, don't just take this from me. This is directly from MLA Marketing services. So they basically market pre-sale condos for all the big developers here in Vancouver. They're similar to like Rennie and Associates. They have the absorption rate, which is how many units are coming on being offered for pre-sale and how many are actually being sold. The absorption rate for the month of April dropped down to 43%. They said that was down from 94% in January, 83% in February, and 63% in March. And again, now we're at 43%. So that absorption rate in the pre-sale market is starting to decline. And this was in a presentation from the MLA, the head of MLA, earlier this week. So you can see that pre-sale. I mean, again, this is like, all you can do is really take you take some of the anecdotal stories and you take some of the data and you sort of combine and you have to sort of formulate your own thesis. As I believe I mentioned in one of these videos previously, is that I'm starting to see it, right? Like, how come every week in my email inbox I'm getting incentives from these developers of $20,000, $30,000 realtor bonus, $15,000, $20,000 decorating bonus for your buyers. These incentives were not even available 3 or 4 months ago. We're starting to see a lot more of these incentives coming onto the market. So that generally tells me that they're having some issues selling this product. But again, that's not just the first thing is the incentives from developers. They rarely like to slash their prices. But I mean, I'd be curious to hear if you've had any sort of pre-sale experience in the last 2 or 3 months. Again, it is sort of a mixed bag. I understand that out in the suburbs, things are still flying off the shelf there for the pre-sale market. But looking at that absorption rate, it's still fairly good at 43%. But you can see down from 94% in January. They're also saying that they have a record number of units being released in May, I believe at 2,300 units. So that'll be a huge test to that pre-sale market. And we're just watching this, right? Again, like I said, you have housing starts still at a record high, and units under construction at a record high. So there's plenty of supply coming. I'm seeing a lot more assignments hitting the market as well, and this will be a space to watch for. I mean, again, you've had record building over the last couple of years, and it seems to be like that's all coming together at a time when credit conditions are tightening and sales are starting to decline. So we'll wait and see how that all plays out. As always, if you have any questions, comments, put those below. Otherwise, I'll see you next week.